When we think back to 2022, the economy was getting absolutely crushed. Moving into 2023, the Federal Reserve is trying to tame inflation. Now, looking into 2024, they're expecting an economic growth of 1.8% per Goldman Sachs, which means we are far from being in a recession. Regardless of the market, regardless of how the markets do perform, no one has a crystal ball and they can't see what is coming in the future. But in today's video, we're going to be looking at 8 ways that you can start investing today. Because of course, when it comes to investing, it is a long-term game. When we think of Warren Buffett in the multiple years that he has been investing, making a majority of his fortune after the age of 65, which means you need to get into the game and really start investing. When we start looking at some of the numbers in here, you will be shocked. Through all the ups and downs that we see in the market, we're going to break down the 15-year trend and of course the single-year trend when it comes to 2024 and where exactly we're seeing. Starting with the first one in the 8 ways that you can invest today is US large cap. Now, of course, we are talking about the VOO, we are talking about the SPDR, the SPY. Looking at the return since 2009, again, going back 15 years, we've seen a lot of things. This was just coming out of the housing market crash. We have also seen COVID. We have seen everything going through the last 15 years. And this has a cumulative rate of return of 580%. That is right. In 15 years, if you started investing in 2009, you'd be up 580%, just literally putting money into that S&P 500, which again is the reason why Warren Buffett said everybody should own the S&P 500. When you look at 2023, so not going from 15 years, but going down to one single year, you would have had a 26% return in the S&P 500. When you think of the large caps, this is the massive big dogs that we know in the United States. We're looking at Apple, Microsoft, Amazon, Eli Lilly, to just name off some of the S&P 500 companies. It is companies and built of companies that have a market capitalization of over $10 billion. And even some of the companies that we see in the S&P 500 are into the trillions of dollars. Now, of course, the way that this is traded, and I want to make sure that you understand this, is depending on the size of the company. When you're investing in an S&P 500 index fund, the larger the company, the bigger percentage is going to be invested in that company. So when you look again at the largest companies in the United States, investing into the S&P 500 is going to put a majority of your money into those super large, mega size tech companies, like we said with Microsoft, looking at even a few that are in there, looking at NVIDIA, some of these companies that are just mammoth in size, but they really dominate a portion of the market, which is the reason why they are so big. Looking at number 2, the US small caps. That is right, getting outside of those mega behemoth large cap companies and looking at the small cap companies. This one focuses on the iShare, the Russell 2000 ETF. Now, since 2009, we have seen a 392% return. That is right, we're just south of a 400% return in 15 years. And then, of course, we look at 2023, we're at 16.83%. Now, again, this is kind of the baby of the investing world, really. So when you look at the US large cap, that is really the massive companies. This one has a lot more volatility. And of course, the net worth of these companies is much lower. When you look at small cap companies, the market capitalization is around $300 million to $2 billion, which we know, again, thinking of those large cap companies, you're looking at $10 billion plus, which means that some of these are a little bit riskier because they are smaller companies. But of course, like we said in the past, there is a really big growth potential because if you have a smaller company and you're investing in it and the company isn't really noticed, maybe they have a breakout product or service that is going to revolutionize the industry, you could see a company that is falling into a small cap stock or, being that $2 billion valuation quickly skyrocket like we've seen with NVIDIA. I mean, they're up, I believe, in the past about year and a half, probably around 700 to 800%, which is kind of incredible to think on how much that company has grown. Number 3, we get into the emerging market stocks. This, of course, is a little bit different because when you look at the emerging markets, this is outside of the United States. So both the S&P 500 and those small caps, we were talking about US. This is going outside of our borders. When you look at the rate since 2009, they've had a 92% return. And even in 2023, we were at about 9% with the emerging markets. Now, this is based on the iShare MSCI Emerging Markets ETF. Most of you know, if you've watched this channel, I invest in ETFs exclusively. Now, of course, the majority of the investing in here is really based on the economy, and it shows Brazil, Russia, India, China, a lot more of a riskier ETF to be in, me personally, that I do not invest in international. And again, this is kind of my personal bias, is when you look at the United States, we have about 50% of the global stock market, and a majority of the companies that are based in the US, like Apple. You have a really global reach of the companies that are based in the United States. There's a lot of them that really function in pretty much every country in the world, which is kind of incredible to think. But through technology, through online, through globalization, we see the ability to essentially put our products and services into every single country. But looking at the emerging markets, some of these are exchange traded funds. We see bonds, we see mutual funds, we see real estate investment REITs, and of course, American depository receipts. So essentially, you could go ahead and invest in a developing nation that is buying US bonds, which essentially you're buying part of the bonds. With that being said, number 4 is the US bonds. Now, of course, when it comes to bonds, me personally, again, very similar to international, I do not invest in bonds. I don't see the return. Even thinking of the E-bonds, the I-bonds, all of those, they had a pretty good run. But looking at the cumulative return since 2009, you're at 35%. That is right. This is based on the iShare Core US Aggregate Bond ETF. The 2023 return on this was 5.65. Now, I don't know about you, but I am getting 5% in a high yield savings account, which means if I went through all of the trouble of holding this ETF, chances are I would be almost on par with what I made last year, giving up a 0.65, but again, not being in the here. Now, of course, this ETF focuses on US bonds and long-term securities issued by the Department of State or the Treasury on part of the United States government, sold for terms of 20 to 30 years, and they pay a set rate every 6 months until they mature. This, of course, is just literally buying bonds. And of course, you're only buying government bonds. You're only buying United States Treasury bonds, which means the exposure and really the risk mitigation is not really there for me. And that, again, is another reason why I do not like and I do not invest in bonds. When the government starts raising interest rates, bond prices are going to suffer, which we have seen right now, making it the absolute worst year in history in 2022 that we have seen in literally all of the US bond history. Then we get into number 5, we look at the high yield bonds. So a little bit different. And of course, this comes with a lot more risk. And again, when you look at the returns of bonds since 2009, we're at 128% based on the iShare iBox high yield corporate bond ETF. And of course, high yield bonds are also referred to as junk bonds, which you have to be careful because they carry an absorbent amount of risk, which can quickly turn into being absolutely worthless. Now, of course, the 2023 rate of return on this was 11.54. But of course, on the other hand, if you're carrying essentially some of the risk or the high risk junk bonds, there is also a very big possible upside to this, which again is the reason why when you're looking at the credit rating of companies and when you start looking at the investment grade, and because of the risk of the high yield bonds, they usually pay a higher return, which again, when you think of the United States Treasury bonds, we're looking at 5.56. When you look at the risk of the high yield bonds, you're at 11.5. So that is exactly where it comes in. Now, of course, if there is a lot of defaults, like unfortunately we're starting to see with a lot of things now, it could be really tough. When you start looking, at the savings and loan scandal of 1980, the dot-com crash in early 2000s, 2008 subprime mortgage crisis, the bonds took an absolute dump. So people that were holding them and really had them in the portfolios seen a devastating effect, which of course, going back to the government getting out of the bonds, getting into the treasury bills. Now, the treasury bill cumulative return since 2009 is 6.25%. Honestly, why would you ever hold them? Now, this is based on the Spider Bloomberg 1 to 3 month Treasury or the T-note bills. The 2023 return was 4.94, which again, I'm getting 5% on a high yield savings account. This is very low risk, very short term, which is the reason why they don't pay a lot of interest. T-bills mature 1 year or less and regularly do not pay interest, but investors can buy them for lower than their face value. And the difference is the return that the investors are getting. And of course, you can also buy T-bills directly from the United States Treasury, or banks and brokerages. I don't think banks actually do them anymore, but I know you can get them at the Treasury at treasurydirect.gov. But again, I would not invest in the T-bills. If you're a large corporation that has a ton of money to throw around, maybe having some in there just for the kind of the... Then, of course, we get into number 7, which is the REITs, the Real Estate Investment Trust. Now, since 2009, we've seen a 265% return, which, of course, this is based on the FTSE, a Near-It Equity REIT Trust US, and the 2023 return was 13.64%. Now, of course, when it comes to REITs, again, there comes with a lot of risk with REITs. And I know when it comes to income generation, REITs are really good. When you look at the owner, operator, or financial companies, REITs often include shopping malls. We see apartments, we see data centers, warehouses. We also see a lot of REITs. And if you've seen Fundrise actually owns individual properties. So they're buying entire subdivisions and renting out the rental, essentially income that you get from the REIT is what they're giving you back. Now, investors own a share of physical property, earning money from the rent and from the property payments that we get. Now, the higher interest rates, like what we're seeing right now, are devastating to REITs because, of course, the purchasing power of properties is exponentially more expensive as we continue to see the rates going up. And the final one we look at it, 8 ways you can start investing today, is, of course, holding gold. Now, for one, you could hold the physical gold. You could actually have the bars. 2, you could go ahead and hold something like we see right here on the SPDR, the Spider Gold shares. Cumulative rate of return on this, 96.73%. 2023 was 12.69. So a little bit lower, but globally accepted as a sign of wealth. Gold is a very popular investment when you look at luxury jewelry, coins, dentistry, aerospace. The price of gold fluctuates, and really it says initially after rising of Russia invaded the really dropped a lot of the gold prices, but we're going to have to see because after Silicon Valley crashed, gold spiked again. A lot of people pulling their money and really safe haven harvesting gold. But of course, gold you can use for a ton of different things. All right, guys, so that is going to do it for today's video. 8 ways you can start investing today. Let me know in the comments what you guys think. And as always, thank you guys for watching.